When you have inflation, it benefits debtors over creditors. In this particular environment, so say the past 10 years, we've had, say, asset price inflation, we've had suppressed wages, we've outsourced labor, we've automated labor. And so this has been a wonderful environment for the top 1%, top 5%, top 10%, and it's been wealth concentration. I think one of the problems especially the past 10 years, kind of the post GFC environment, a little over
Mm.
10 years, is that, for lack of good money, people are clearly monetizing other things, right? So in the US, we have the highest equity valuations as a percentage of household assets we've ever had. Um, and well, it goes back to the whole there is no alternative, Tina, right? So
Yeah.
they're like, well, I can't hold cash and bonds, and so I got to buy equities, even though I'm looking at, say, the CAPE ratio or the market cap to GDP ratio or whatever your preferred valuation metric is, and you're saying, well, I know they're expensive, but I have to hold them anyway. And so in many cases, we've essentially monetized the S&P 500 as a store of value rather than thinking of it as an investment. It's like we got to just shove money in there that we don't know what else to do with, because we can't just leave it in T-bills. And so the same thing's true for prime real estate. So if you're a billionaire and you're trying to figure out how to preserve your wealth, you're like, well, I mean, I don't know how to value this beachfront property. It seems expensive. It doubled over the past 2 years, but I'd still rather own this than T-bills. And so the argument among some of the really bullish Bitcoiners is that if you do continue to reach certain thresholds and Bitcoin just keeps going, um, it becomes, if you have this kind of global hard money, it becomes an alternative that people have monetized these other assets. They've essentially added a monetary premium that is above their utility value. During a transition, if you suck monetary premium out of a house, you could also suck a monetary premium out of something that is enabling new technology, new productivity. And so any transition like that is going to be a challenge. But I think if that hypothetical scenario were to play out, I think it would come with pros and cons. But I think as the dust settles, that should be a healthier environment to because if you go back in history, people should be able to essentially save money in something that's not speculative in order to, you know, build a retirement. And so they shouldn't have to have like 100% of their net worth in equities. They should have something that they can save in that's somewhat reliable. And right now, there's just not a lot of good alternatives for that, including Bitcoin at this current size, because for a lot of people, it's too volatile. And so, someone who's put 1,000 hours of research into Bitcoin obviously can handle generally a larger position than someone who's just trying it out and just kind of learned about it last week. So there's that kind of if you were to chart like knowledge and conviction versus allocation, there's going to be a change there. And going back to the whole thing, if we say, okay, if Bitcoin's going to have a very high, say, double-digit CAGR over the next decade, some people ask, why not just put everything into it? I've had people ask me that question, and I said ultimately it's because of tail risks and it's because of human nature and volatility. And so I have a large allocation into Bitcoin, partially because I put a decent chunk into it, and also because it appreciated, fortunately, and it just didn't rebalance it, right? So it's a large chunk, but it's still small enough that when this summer, for example, Bitcoin more than got cut in half, I was like, it's not like if so when people put their entire net worth into something like that, that's where they lose sleep, right? So people can I think there's a range of allocations that make sense, but it comes down to their individual temperament, comes down to their knowledge on it, their conviction on it, and what kind of lifestyle they have, what their obligations are, as we go forward. Hyperinflation is like always bad, right? So when a currency breaks, almost 99% of people have trouble. Businesses can't function when there's no pricing mechanism, and it's just bad for everyone. And even these like near like things that aren't technically hyperinflations, but just like horrible inflations that you see throughout emerging markets, where savings just get erased every generation or so, or cut in half. Those are terrible, and people should have a way to defend against that. That's like the work of Alex Gladstein, from the Human Rights Foundation, talks about Bitcoin usage in emerging markets. How a lot of these people, they just don't, they don't have access to stocks. They're stuck in their local currency, and their currency gets devalued, and they just have to start all over. Whereas something like Bitcoin is a tool that they have now that basically kind of think gives them back some of that power. So there's that set of scenarios. If we look back and say United States history, If you look at the 1940s, the 1970s, inflationary decades, you actually had a partial reduction in wealth concentration during those decades, as measured by, say, the share of wealth owned by the top 0.1% or the top 1%, however you want to define it. You had a contraction in wealth concentration. My overall approach is basically that I see that global reserves are diversifying more. And so we have kind of Russia and China interested in de-dollarizing to some extent, and so my framework is essentially that the dollar is shifting from, the global reserve currency, meaning like the only currency you can buy oil in, to, a reserve currency, perhaps still the biggest, and just kind of a lower percentage of that basket. And then, there's some areas where the U.S. is like the cleanest dirty shirt, so it's got some of the best geography. They say the central bank balance sheet is still a smaller percentage of GDP, than say the ECB or Japan. And whereas the areas that we're the dirtiest dirty sheet in generally relate to our wealth concentration, our structural trade deficit, and military industrial complex spending, those sort of deficit spending, healthcare costs as a percentage of GDP or per capita, compared to outcomes. So we have a lot of kind of those specific issues. But yeah, in terms of the long-term debt cycle, many of these countries are in similar circumstances, especially at least among the developed world, as a whole. When you have inflation, it benefits debtors over creditors. And so people often use the narrative that the problem is that, the wealthy, they have all these inflation indexed assets, they have these hard assets, so they don't mind inflation, but that the poor and the middle class, they have most of their assets in cash, and that gets inflated away. But that's actually only partially, that's missing a big picture, because if you look at, the data of the bottom 50%, and then you look at the next like 40%, the middle 50 to the 90, then you look at the next 9%, and you look at the 1%. If you segment those four groups, as you go down the income spectrum, they have higher debt to asset ratios. So the bottom 50% have almost zero net worth because, they have roughly as much liabilities as assets. Then when you go up to the next group, the kind of the middle to upper middle class, they have more assets than liabilities, but still quite a bit of liabilities. They generally have a very large, say, fixed rate mortgage. They might have credit card debt. And as you go up, into the top 1%, they're actually very unlevered on average, unless they happen to be like a real estate mogul or something. Their entire net worth in real estate, they're highly leveraged. But other than like, specific examples, they are generally very unlevered. In this particular environment, so say the past 10 years, we've had, say, asset price inflation, we've had suppressed wages, we've outsourced labor, we've automated labor. And so this has been a wonderful environment for the top 1%, top 5%, top 10%, and it's been wealth concentration.